Bitcoin keeps outperforming other safe haven assets. What if everything you thought was safe about money wasn't actually safe at all? For decades, people have trusted the same playbook. When markets crash, you move into gold. When uncertainty rises, you hold cash. When fear spreads, you look for safe haven assets. But what if the asset everyone once called risky has quietly been outperforming them all? Not just in bull markets, not just during hype cycles, but across crises, inflation shocks, and global uncertainty. Bitcoin, the same asset once dismissed as a speculative experiment, is now challenging the very idea of what safe means. And the deeper you look into the data, the more uncomfortable the truth becomes. Because if Bitcoin continues to outperform traditional safe havens, it could change how the world protects wealth forever. So, here's the real question. Why does Bitcoin keep outperforming assets that were designed to be safe? Gold has thousands of years of history. Government bonds are backed by entire nations. Cash is still the foundation of everyday transactions. These assets weren't chosen randomly. They earned trust over centuries. So why is a digital currency, barely over a decade old, outperforming them? Is it just volatility? A temporary trend? Or is something deeper happening beneath the surface of the global financial system? Because if Bitcoin isn't just outperforming, but replacing the role of safe haven assets, then we're not just watching a market shift. We're watching a complete redefinition of what safety means in finance. And that changes everything. To understand this, you have to go back to how the world traditionally defines safe. A safe haven asset is something investors run to when everything else falls apart. During wars, economic crises, inflation spikes, or market crashes, people don't want growth. They want protection. For most of modern history, gold has been the ultimate safe haven. It's scarce. It's tangible. And it's survived every financial system ever created. Then there's government bonds. Especially US Treasury bonds. They're considered low risk because they're backed by the government's ability to tax and print money. And of course, cash. In times of panic, people hold dollars because they're liquid and universally accepted. This system worked for decades. But then something changed. In 2008, during the global financial crisis, trust in the system cracked. Banks failed. Governments intervened. Money was printed at unprecedented levels. And out of that chaos, Bitcoin was born. At first, almost no one took it seriously. It was volatile, experimental, and misunderstood. But while traditional assets were maintaining stability, Bitcoin was doing something different. It was growing fast. And over time, something unexpected started happening. Every major financial crisis seemed to push Bitcoin higher. Here's the first key insight. Bitcoin isn't just outperforming safe haven assets. It's responding differently to the same conditions. When inflation rises, traditional safe havens are supposed to protect purchasing power. But in recent years, that protection hasn't been as strong as expected. Gold has had periods of stagnation. Bonds have suffered during rising interest rates. Cash loses value quietly through inflation. But Bitcoin? It operates on an entirely different system. Its supply is fixed. Only 21 million will ever exist. No central authority can print more. No government can dilute it. So, when the world prints money, Bitcoin becomes relatively more scarce. And scarcity is what drives value. But here's where things get interesting. Bitcoin doesn't just benefit from inflation. It benefits from uncertainty itself. Every time confidence in traditional systems weakens, Bitcoin gains attention. Every time trust in institutions declines, Bitcoin becomes more attractive. Not because it's stable, but because it's independent. And that independence is starting to matter more than stability. But here's the twist that most people miss. Bitcoin isn't behaving like a traditional safe haven. At least, not yet. Safe havens are supposed to be stable, predictable, low volatility. Bitcoin is the opposite. It's volatile. It crashes hard. It moves fast. So how can something so unstable outperform assets designed to be safe? Because the definition of safety is changing. In the past, safety meant stability. Today, safety is starting to mean something else. Resilience. Protection from currency debasement. Freedom from centralized control. Bitcoin may be volatile in the short term, but over longer timeframes, it has consistently recovered. And not just recovered. It has reached new highs. Again and again. Meanwhile, traditional safe havens are facing new challenges. Governments are increasing debt. Currencies are losing purchasing power. Interest rates fluctuate unpredictably. The systems that once defined safety are no longer as reliable as they used to be. And Bitcoin exists outside of all of them. That's the twist. Bitcoin isn't replacing safe havens by becoming more stable. It's replacing them by solving a different problem. So, what's really driving Bitcoin's outperformance? It comes down to three powerful forces. First, absolute scarcity. Gold is scarce, but its supply can still increase through mining. Fiat currencies can be printed infinitely. But Bitcoin's supply is fixed by code. Every 4 years, the rate of new Bitcoin creation gets cut in half. This event, known as the halving, reduces supply growth even further. And over time, this creates a powerful imbalance. Demand increases. Supply stays limited. Prices rise. Second, global accessibility. Traditional safe havens aren't equally accessible to everyone. Buying gold can be difficult. Accessing bonds requires financial infrastructure. Holding large amounts of cash can be risky. But Bitcoin? Anyone with an internet connection can access it. It doesn't require permission. It doesn't depend on a bank. It doesn't care where you are in the world. This makes it uniquely positioned in a globalized economy. Third, narrative momentum. And this might be the most underestimated factor. As more people begin to see Bitcoin outperform traditional assets, they start to reconsider its role. At first, it was digital gold. Then it became a speculative asset. Now, it's increasingly seen as a store of value. And narratives matter in financial markets. Because belief drives adoption. And adoption drives price. But here's where things get even more interesting. Institutional investors are starting to pay attention. Large funds, corporations, even governments. They're beginning to allocate small percentages of their portfolios to Bitcoin. Not because it's safe in the traditional sense, but because ignoring it is becoming riskier. And that shift, from optional to necessary, is what fuels long-term outperformance. But this isn't a one-sided story. Because Bitcoin's rise comes with real risks. And ignoring them would be a mistake. First, volatility. Bitcoin can drop 50% or more in a short period. That's not something traditional safe havens typically do. For many investors, that level of risk is unacceptable. Second, regulatory uncertainty. Governments still have the power to influence how Bitcoin is used. Regulations can change. Restrictions can be introduced. And while Bitcoin itself is decentralized, access to it can still be affected. Third, competition. Bitcoin isn't the only digital asset. New technologies are constantly emerging. And while Bitcoin has a strong first-mover advantage, nothing in technology is guaranteed forever. And then there's perception. Bitcoin is still misunderstood by many. Some see it as speculative. Others see it as a bubble. And until that perception fully shifts, its role as a safe haven will remain debated. But here's the key point. Every asset has risks. Gold has storage and liquidity challenges. Bonds are vulnerable to inflation and interest rates. Cash loses value over time. The difference is, Bitcoin's risks are visible. Traditional risks are often hidden. And as more people begin to recognize those hidden risks, they start looking for alternatives. So, what does all of this mean? It means we may be witnessing a shift that only happens once in a generation. A shift in how the world defines safety. For decades, safety meant trusting institutions, trusting governments, trusting systems built long before the digital age. But now, a new form of safety is emerging. One that doesn't rely on trust. One that doesn't depend on central control. One that is defined by code, scarcity, and global access. Bitcoin may not look like a safe haven. It may not feel like one. But its performance is forcing people to ask a dangerous question. What if the safest asset is the one we've been told is the riskiest? And if that question continues to spread, then Bitcoin isn't just outperforming safe havens. It's redefining them. And the world hasn't fully realized it yet.